Today we're counting down 7 car brands in serious trouble right now. We're not talking about startups or forgotten nameplates. These are companies that dominated motorsports, defined entire segments, and moved millions of vehicles. But they made catastrophically wrong bets on electric vehicles, ignored dealer networks until it was too late, or got steamrolled by Chinese manufacturers building competitive EVs for half the cost. And the number one pick? They might not make it to 2027. Stay to the end. You need to know which brands are circling the drain before you sign that loan paperwork. Some brands on this list will survive through brutal restructuring. Others? We're watching their final chapters. Let's count down from struggling to absolutely catastrophic. Number 7. Mitsubishi. Remember when Mitsubishi made the Lancer Evolution and actually mattered in motorsports? Those days are long gone. Today, Mitsubishi is watching its US dealer network collapse in real time. The numbers are brutal. Mitsubishi has only 300 dealers left in the United States. That's a fraction of what Toyota, Honda, or even Subaru operates. Average dealer profit dropped from 2.2% in 2023 to 0.92% in 2024. Translation: dealers are basically breaking even, hoping things improve. Here's how bad it is. In the Midwest alone, 4 out of 15 Mitsubishi stores went out of business in a single year. One dealer told Automotive News they're losing $80,000 per month just keeping the lights on. When your dealer network is operating as a charity, you don't have a business. You have a problem with a 3-diamond badge. The product lineup isn't helping. The Outlander Sport dates back to 2011. The company discontinued the Mirage, their affordable entry model that accounted for significant dealer volume, with zero replacement. They raised prices 22% over 4 years while cutting incentives by 26%. Dealers are trying to sell aging products at higher prices with less manufacturer support. That's not a strategy. That's surrender. Mitsubishi's partnership with Nissan was supposed to help, except Nissan is also drowning, as we'll discuss shortly. Relying on Nissan's EV platform for your 2026 comeback is like asking someone in quicksand to throw you a rope. Still, Mitsubishi might survive. Their Momentum 2030 plan promises 1 new or refreshed model annually through 2030. They just signed major dealer groups like LaFontaine and Walser, and parent company Mitsubishi Group has deep pockets if they decide the automotive division is worth saving. Plus, Mitsubishi remains strong in Southeast Asian markets, where affordability matters more than brand prestige. The question is whether Mitsubishi can execute fast enough to stop the bleeding. Dealers can't wait until 2030 for profitability. Number 6. Volkswagen. When you close a factory in Germany for the first time in your 88-year history, you're not making adjustments. You're fighting for survival. Volkswagen just shut down its Dresden plant, marking the first production shutdown at a German site ever. They're cutting 35,000 jobs by 2030 and slashing production capacity by 734,000 units. The company projects an €11 billion cash shortfall for 2026. Volkswagen's operating margin sits at 2.3%. BMW and Mercedes, 10.9% and 9.9% respectively. VW is getting destroyed by competitors on their home turf. The core problem is Volkswagen bet everything on electric vehicles. They committed 160 billion euros to electrification. That's not a typo, 160 billion. They built factories, retooled production lines, discontinued profitable gasoline models, then consumers didn't show up. Now VW runs facilities at partial capacity, hemorrhaging cash while facing EU fines if they don't sell enough EVs to meet carbon dioxide targets. But they lose money on every EV sold. It's the world's most expensive catch-22. Build more EVs and lose more money per unit, or pay massive fines for missing targets. Meanwhile, Chinese manufacturers like BYD build competitive electric vehicles for literally half of Volkswagen's production costs. VW spent decades building an advantage in internal combustion engines. That expertise means nothing when the market shifts to batteries and software, areas where Chinese companies excel. Factory costs run 25 to 50% above target versus competitors. German labor unions blocked reforms for years. Now those chickens are coming home to roost. VW CEO Thomas Schaefer admitted some German plants are twice as expensive as competitors. Volkswagen will likely survive because they're too strategically important for the German government to let fail. They reached a union deal avoiding immediate mass closures, and premium brands like Porsche remain highly profitable. Skoda is actually performing well, but the VW brand itself, that's in intensive care. The CFO admits 2025 and 2026 will show only slightly positive cash flow. For a company this size, that's terrifying. Number 5. Alfa Romeo. Alfa Romeo has been on the verge of a comeback for about 15 years now, and Stellantis finally seems ready to admit defeat. U.S. sales dropped 70% since 2021. In 2024, Alfa Romeo sold exactly 8,865 vehicles in the entire United States. Ford sells that many F-150s in about 3 days. Toyota moves more Corollas in a typical week. Alfa Romeo's entire annual U.S. sales wouldn't fill half the parking lot at a major NFL stadium. At this point, they're not a car company. They're a rounding error in Stellantis quarterly reports. Sales continued falling in 2025, down 34 to 36% depending on the quarter. The quadrifolio versions of the Giulia and Stelvio, the only models that generated any enthusiast interest, got canceled for the U.S. market. That leaves 3 vehicles total: the Giulia sedan, Stelvio SUV, and Tonale crossover. None of them sell in meaningful numbers. Stellantis reportedly hired McKinsey to evaluate the future of both Alfa Romeo and Maserati. When a consulting firm gets brought in to assess 2 Italian brands simultaneously, that's management speak for deciding which one dies first. The parent company is losing billions. They're not investing heavily in Alfa Romeo's future. The dealer network shrinks annually. Originally, Stellantis promised a full electric lineup for Alfa. Now they're backtracking because EVs aren't selling. But internal combustion vehicles aren't selling either when you're Alfa Romeo. Here's what nobody at Stellantis wants to say out loud. Alfa Romeo loses money on every vehicle sold in the US. The brand exists for prestige in Europe and to justify Stellantis calling itself a global luxury player. Those 8,000 American buyers, if they disappeared tomorrow, would Stellantis actually notice? Alfa might survive by retreating entirely from North America and focusing on Europe. New Giulia and Stelvio models are supposedly coming on a different platform. CEO Jean-Philippe Imparato seems committed. But survival and success are different things. Alfa Romeo might exist in 2030, but will anyone care? Number 4. Jaguar. 49. That's how many Jaguars were registered across all of Europe in April 2025. Your neighborhood might have more Jaguars parked on the street right now than were sold continent-wide last month. The previous year, Jaguar sold 1,961 vehicles in Europe during April. This year, 49. That's a 97.5% collapse. Year-to-date sales are down 75%. Here's the thing. This was intentional. Jaguar discontinued their entire internal combustion lineup, every single vehicle, before their electric replacements were ready. They created a 12 to 18-month gap with no product. Dealers sit with zero inventory, losing revenue. Customers looking for a Jaguar literally cannot buy one. The rebrand strategy was catastrophically tone-deaf. Jaguar unveiled controversial new logos and marketing campaigns featuring gender-neutral models with vague slogans like "Copy Nothing," while having literally 0 cars available to sell. They alienated existing customers and attracted nobody new because, again, there were no cars to buy. It's like announcing you're now a vegan restaurant while the kitchen is closed for 2 years. BMW, Mercedes, and Audi each sold between 50,000 and 75,000 vehicles in Europe. During the same month, Jaguar sold 49. Jaguar's managing director admitted only 15% of current buyers will return for the electric vehicles. That means they're intentionally abandoning 85% of their customer base, gambling everything on attracting entirely new buyers at Bentley and Rolls-Royce price points. The flagship electric GT won't arrive until late 2025, priced around $200,000. Jaguar is betting ultra-wealthy buyers will spend that much on a brand that hasn't made anything noteworthy in years and whose legacy is electrical problems, and catastrophic depreciation. A cyber attack cost Jaguar Land Rover $250 million this year. Profit margins dropped from 10% targets to 5 to 7%. U.S. tariffs are hitting hard since 25% of JLR sales come from America. Dealers report revenue drops of 60 to 90%. Jaguar might survive because parent company Land Rover posted record profits of £2.5 billion. Land Rover's success buys time for Jaguar's gamble. Website traffic did increase 110% after the rebrand, though that's curiosity, not purchase intent. If the $200,000 GT is genuinely spectacular and reviews are glowing, Jaguar stages an unlikely comeback. If it's merely good, the brand disappears. This is the biggest all-in bet in automotive history. Number 3, Chrysler. Pop quiz. Name a Chrysler vehicle. Now name a second one. If you said Pacifica twice, you're not wrong, because that's literally their entire lineup. Chrysler sells 2 vehicles, the Pacifica minivan and the Voyager. Except the Voyager is just the Pacifica with different badges. So really, Chrysler sells 1 vehicle with 2 names. That's their complete portfolio. Sales dropped 22% year-to-date in 2025, with a 42% collapse in Q2. Pacifica sales specifically fell 29% in the first half of the year. The Airflow EV concept that was supposed to save the brand? Canceled. No new products have been announced. 0. The Chrysler 300, their only other model, got discontinued in 2023. Chrysler currently sells fewer models than some motorcycle manufacturers. Honda's Odyssey outsells both Chrysler minivans combined. The brand that invented the minivan segment is now losing that segment to Toyota, Honda, and Kia. When you can't dominate the category you created, you're not struggling. You've already lost. Stellantis clearly gave up on Chrysler years ago. Former CEO Carlos Tavares wanted only high-margin luxury vehicles. Chrysler doesn't fit that strategy. The brand has no identity and no purpose in the lineup. Dealers carry Chrysler only because franchises are bundled with Jeep and Dodge. Everyone over 40 remembers exactly what this looks like. General Motors kept Oldsmobile alive for years, with badge-engineered vehicles and vague promises of future products. Then one day they announced closure, and nobody was surprised. Chrysler is following the identical playbook. Stellantis is openly considering brand rationalization. That's corporate speak for shutting down money-losing divisions. The similarities to GM killing Pontiac, Saturn, and Oldsmobile in 2009 are impossible to ignore. The minivan segment shrinks yearly as buyers shift to SUVs. Chrysler has no emotional connection with customers. Their sales come mostly from fleets and rental companies. It makes more business sense to rebadge the Pacifica as a Dodge and consolidate dealers. Chrysler could survive if Stellantis invested in one new product. The dealer network already exists. Minivans still generate profit on a per-unit basis. But when your parent company is hemorrhaging billions across multiple brands, Chrysler won't get that investment. The only question is whether Stellantis pulls the plug in 2026 or 2027. Chrysler isn't dead yet, but it's not alive either. Number 2, Maserati. When you sell fewer cars than Ferrari despite costing less and being less exclusive, you don't have a luxury brand. You have a crisis wrapped in Italian leather. Maserati's sales collapsed 58% in 1 year, from 26,600 units in 2023 to just 11,300 in 2024. They're on pace for only 8,000 units in 2025. Operating losses exceeded $260 million last year. Stellantis wrote off $1.6 billion in canceled Maserati EV projects. Here's the most damning statistic. In October 2025, Maserati sold 124 vehicles in the United States. Ferrari sold 298. Lamborghini sold 244. Maserati, positioned as the affordable Italian exotic, got beaten by brands costing twice as much. It's like losing a sprint race while riding a motorcycle against people on unicycles. The only explanation is nobody wants what you're selling. When your product is a $90,000 luxury vehicle, nobody wanting it is a death sentence. Stellantis made catastrophic strategic errors. They pushed Maserati all in on expensive electric vehicles nobody wanted. The Folgore electric range flopped completely. They discontinued the Ghibli, Quattroporte, and Levante sedans without replacements, leaving massive holes in the lineup. The new Gran Turismo and Gran Cabrio launched at insane prices. When sales tanked, Maserati cut prices, which destroyed brand prestige. The Gracal SUV, supposed to be their volume model, isn't offered with the V6 hybrid engine customers actually want. Production chaos ensued, with the Mirafiori plant in Italy shut down repeatedly. Production at that facility dropped 70% in 2024. CEO turnover hit in October 2024, when Davide Grasso got replaced by Santo Fascili, who also runs Alfa Romeo. Stellantis hired McKinsey to evaluate Maserati and Alfa Romeo's futures. When consultants show up to assess two brands simultaneously, that's management deciding which one dies first. New CEO Fascili claims they're targeting 15,000 to 20,000 annual sales with profitability by 2028, but they're currently at an 8,000 annual pace with no new products announced. Competition intensifies from Lucid, Polestar, and established luxury players. Brand reputation suffered massive damage from recent quality issues. Stellantis can't keep funding $260 million annual losses while fighting for their own survival. The parent company posted a $2.7 billion loss in the first half of 2025. Most likely outcome? Maserati gets sold to a Chinese automaker wanting instant luxury credibility, or it gets merged into skeleton Alfa Romeo operations. The Trident badge might survive. The brand as we know it, that's already gone. Maserati is living on borrowed time that runs out soon. Number 1. Nissan. When a senior executive tells the Financial Times that your company has 12 to 14 months to survive, you're not restructuring, you're in hospice. Nissan posted a $4.5 to $5 billion net loss for the fiscal year ending March 2025. They're closing 7 plants globally by 2027. Job cuts doubled from 9,000 to 20,000. They're slashing production capacity by 25%. Renault, who saved Nissan from bankruptcy in 1999, reduced their stake from 46% to under 36%. The $60 billion Honda merger talks collapsed, and a major supplier, Marelli, filed for bankruptcy, owing Nissan $313 million. Let's talk about what 12 to 14 months to survive actually means. That's not marketing spin or pessimistic forecasting. That's a senior executive publicly stating that if Nissan doesn't turn things around by mid-2026, the money runs out. This is the same company Renault rescued from bankruptcy 26 years ago. Now they're right back on the edge, except Renault is backing away rather than doubling down. When your previous savior reduces their stake by 10 percentage points while you're hemorrhaging billions, that tells you everything about your prospects. Nissan initially predicted a $560 million loss. Then they revised it to $5 billion, nearly 9 times worse than expected. They logged 500 billion yen in impairment charges across North America, Latin America, Europe, and Japan. The company refused to issue an operating profit forecast, which is unprecedented. CFO Stephen Ma resigned. The product problems run deep. Nissan's CVT transmission reputation still tanks resale values years after the worst failures. They missed the entire SUV boom while competitors dominated. Their early EV advantage with the Leaf got completely squandered. The Ariya isn't competitive against Tesla or Hyundai. Core sedans like the Altima and Versa are discontinued with no replacements. Infiniti, their luxury brand, was neglected for over a decade. Nissan isn't circling the drain. They're already in it. The 12 to 14-month timeline isn't a warning. It's an obituary with the date already written. 7 brands, 7 different crises, 1 brutal pattern. The automotive industry doesn't reward complacency anymore. Chinese manufacturers build competitive EVs for half the cost. Consumers demand value over heritage. And supplier bankruptcies expose how fragile this ecosystem became. Some brands will survive. Volkswagen is too big to fail. Mitsubishi has a plan. Jaguar's gamble might work. But Nissan's 12-month timeline isn't a threat. It's a prediction. And if a company that survived since 1933 can implode this fast, no brand is safe. Speaking of brands making terrible decisions, check out our video on 13 trucks only stupid people buy. Because some vehicles are built to fail from day one, and you need to know which ones before you sign that loan.